Crypto trading is exciting until tax season hits. The IRS wants their cut, and if you don't know how each type of trade impacts your taxes, you could be paying way more than you need to, or worse, making costly mistakes. Don't hire the wrong people. But don't worry. Today, we're breaking down exactly how every type of crypto transaction is taxed, from spot trading to staking, airdrops, NFTs, and even DeFi loans. Stick around, because by the end of this video, you'll know how to file your crypto taxes the right way. Do you want to file them? Let's get it. I'm not a financial advisor. Welcome to Bitboy X, home of the Bit Squad, the highest IQ investors in all the interwebs. I'm your host, the Bitboy, and that's right, guys. I didn't do my crypto taxes, and the IRS, they came to collect. If you're ready to understand how crypto taxes work and ensure you're not overpaying or making other costly mistakes, smash that like button, subscribe, and hit the notification bell. One of those mistakes is not paying too little. You never pay too little in taxes. But if you want an easy way to calculate, track, and file your crypto taxes without the stress, check out Zenledger's Complete Tax Guide, linked in the description down below. Crypto taxation isn't as simple as buying and selling stocks. Every trade, swap, or even airdrop has a potential tax implication, and the IRS treats crypto as property, not currency. This means that every time you use, trade, or sell crypto, it can trigger a taxable event. Let's break down the most common types of crypto transactions and how they impact your taxes. Buying crypto with fiat, well, it's not a taxable event. However, it's crucial to keep track of your cost basis, the price you paid, because this will be used to calculate gains or losses when you sell or trade. Selling crypto for fiat is a taxable event. If you sell crypto for USD or any fiat currency, you owe capital gains tax. If you held the asset for less than a year, you'll pay short-term capital gains tax at your regular income rate. If you held for more than a year, you'll qualify for long-term capital gains, which is taxed at a lower rate. One of the biggest tax surprises for new crypto traders is that swapping one cryptocurrency for another is a taxable event, even if you never converted to fiat. The IRS treats it as if you sold one asset and bought another. If you swap Ethereum for Solana and Ethereum has appreciated in value since you bought it, you owe capital gains tax on the difference. This is why tracking cost basis is crucial, and why tax tools like Zenledger can automatically calculate this for you, so you don't have to do all the complicated math, because you know it's complicated. If you use crypto to buy a car, pay for a flight, or even buy a cup of coffee, can you do that? The IRS treats this like it's selling crypto, meaning you owe capital gains tax on any appreciation since you originally acquired the crypto. Guys, can we just be honest for a second? Can we just come in real quick? Hey guys, I just want to tell you all this. I don't know if y'all know this. If y'all make money, the government's gonna want some of it. Okay. This makes crypto spending also a bit complicated, though. This is really where it gets complicated to me, honestly, because even a simple purchase could trigger taxes if your crypto has gained value. If you stake your crypto, mine Bitcoin, or receive block rewards, those earnings are taxed as income based on the fair market value of the coins at the time that you receive them. This income is taxed at your ordinary income tax rate. However, if you later sell or trade the crypto that you earned, that's another taxable event. And capital gains tax applies on any appreciation since you've received it. So if you stake Solana and you earned 5 SOL tokens when it's valued at $100 per token, you owe income tax on that $500 worth of Solana that you made. I don't know, kind of simple, I think. If later though you sell it for $200 per token, you'll owe capital gains tax on the additional $500 gain. Now, if you receive free crypto from an airdrop or from a hard fork, that's also considered taxable income at the moment you receive it, based on its fair market value. Even if you didn't sell the tokens, the IRS expects you to report them. This is where it gets a little confusing too. It's one of the most misunderstood parts of crypto taxation, and missing it could flag your return for an audit. DeFi is where things get tricky, and the IRS is still figuring out how exactly to classify yield farming, lending, and borrowing. In general, if you lend crypto and earn interest, that's taxable as ordinary income. If you receive tokens as liquidity mining rewards, those are also taxable income. If you borrow crypto using it as collateral, that isn't taxable. But if your loan is liquidated, you could owe capital gains tax. Using Zenledger's DeFi tracking tools is a crucial way to sidestep complicated things because it automatically classifies each transaction based on IRS guidelines. With all these different taxable events, you need to keep detailed records of every trade, swap, and income source. Manually doing this is a nightmare. I don't know, I tried to do it with a bunch of Post-it notes one time, it didn't work. So I hired some people and that didn't work either. But hiring the right people is so important. That's why serious traders use crypto tax platforms like Zenledger. Zenledger syncs with over 400 exchanges and wallets to track transactions, automatically generate IRS compliant tax reports, and include an in-app tax filing feature so you can file your full tax return without leaving the platform. It also provides a tax loss harvesting tool to help minimize your tax bill legally. For more detail, check out ZenLedger's complete crypto tax guide linked in the description below. Crypto taxes, they're not something you can just ignore no matter how many years go by. Every trade, swap, and transaction matters. And with the IRS getting more aggressive about crypto reporting, staying compliant is more important than ever. The good news is that with tools like ZenLedger, you don't have to stress. It does all the heavy lifting, tracks every transaction, and ensures you never overpay or underreport. So here's the bottom line. Crypto taxes don't have to be confusing. Understanding how your trading, staking, and DeFi strategies and activities impact your tax bill is key to saving money and avoiding headaches. If you want an easy way to track and file your crypto taxes, check out our sponsor. Thank you for the sponsorship, guys. ZenLedger, they have a full tax guide. We got it down below in the description. Use the code BitBoy10. Do not forget this. You get 10% off for new users. Got questions? Drop them in the comments. Don't forget to smash that like button, subscribe to the channel, and hit that notification bell. Stay ahead. Don't get unplugged from the Bit Squad. That's all I got. Be blessed. Don't be low IQ. BitBoy out.